So let me make you guys understand something about compounding and risk in financial markets. Now, professional traders, licensed traders, traders who really know what they're doing and really understand this business and are really good traders, do not use Albert Einstein compound plan. That comes from IML, the eighth wonder of the world. He who knows it earns it, and he who don't pays it. Retail traders have tried to follow that formula in their risk management and in their risk application for a very long time, and they have failed and never been able to achieve it. Why? Because that's just not how financial market works. There is no levels to this thing. This is a business. It's a percentage-based business, and there's a different type of systematic framework and process surrounding your risk of how you really accumulate and compound in financial markets. And it doesn't look like this. Every trade is directly associated with risk, and the market is dynamic, market conditions change, and you will not be able to achieve what you set out to achieve with a risk. It looks good on paper, in theory, it looks beautiful, numbers look large, no losses in there, no risks associated with it, just direct capital, percentage, grow, percentage, grow, percentage. So I'll leave it like this, so you get the picture. You might have seen this circulating on social media. So once you see somebody using this, you know they are not a good trader, they are not a professional trader, they are not a successful trader, number one. They gotta be lunatic, mad, crazy, something gotta be wrong with them. Doesn't matter if they are wrong 9 years now or 10 years now. Something definitely gotta be wrong with them. Disgrace to the trading race. Don't even need to be in financial markets. They could blame the news events, they could blame market conditions of why they can't trade, why they lose their account, why they lose money, why they get beat up from financial markets, and so many different things. But understand something about risk. So you have to understand the platform that you're using also. Whether you're trading through Binance, futures, whether you're trading through a normal brokerage account where you get a leverage, then you have pips. You have to use pips, lot size. You have lot size in there. Great, and or you're using a derivative platform where it gives you like a one-to-one. There's nothing you can do about it. If you risk 50, you get approximately 50 in return, and it have a expiry date on the contract. So there are different platforms that you can trade through, but they kind of allow you to do different things on them. Like for futures, like the trading through Binance or one of these crypto exchange, you will have to 25%, 50%, 75%. Okay, so $1,000, if you put 25% on, that's $250 from there. If it's 50%, that's $500 from your total capital. Yeah, now when it comes to your earning profits, you got to get a whole, how much? 1,000 move to just earn just 20% of that. So how much that's like a one-to-one. You got to risk 250 to actually get like less than a one-to-one. So when you understand the different platforms that you're trading on, you will understand what it allows you to do and how you have to really calculate and check your returns to see which platform really makes sense for you to trade off of, for you to achieve whatever you're looking to achieve. So when you have $1,000 account, what lot size are you trading on? Let's say if you were trading on a 0.01, a 0.10, that is $1 per pip. Now you have this 20% look on your compounding sheet. So that 20% of $1,200, right? So if you trade on a 0.01, how much pips you have to catch to actually make $200? You gotta catch 200 pips. For you to actually get that. Now, if the market don't move 200 pips, if the market don't move 200 pips, if you don't catch a 200 pip move, how are you actually gaining this all the time? Then too, you gotta look at what type of risk is associated with a move like this. So how much pips would you risk on a move like this? How much would you expose? Would you use a 50 pip stop loss? Would you use a 30 pip stop loss? So are you risking $30 or $50 to go for that 200? Now, the market is going up, you enter, you risk here, the market comes down, stop you out. Then continue and goes its way. So what happens? You lose. You go next day, you try to fish again. Because you have such a small, you try to sell down. The entry here, the stop loss here, market swing back up, boom, stop you out. Now you're trying to trade daily to achieve this percentage every day. The market is dynamic. The market conditions are changing. You're trading in a spot in financial markets that is very random. The odds is against you, the algos is against you, the market makers is against you, the brokers is against you. You're on the 1 minute time frame. You're on the 5 minute. You're on the 15 minute. Nice. And you are trying to achieve a daily percentage like this, not looking at what you're actually trading off of. If you're using features and you use 25% of your, put 25% of your account, that's $250. That's $250 from your $1,000. And then you got to get a whole 1,000 points move before you can even get a 20% return. So you see the difference between the platform. The risk is lower here. The earning potential is higher, which means the risk to reward is now higher. Here, if you got to put 250 on to get a 20% move, by a 1,000 pip move to get a 20%, for you to get $200, that means you're exposing yourself 250 and you're not even getting back that type of return. Nice. So it's less than a 1-to-1. You're putting out more to even gain less. And you're not going to be able to achieve that all the time. The market is going to catch you and trap you up and damage you. So different platforms. If you're on a staking platform, if you go there and you have $1,000 and you want to make you want to make 200, you got to put on $200. And then you will get like probably 199 return. And then you're using contracts, so time is against you. So if you buy a contract, you can buy a 1 hour contract. You can buy a 4 hour contract. You can buy a 15-minute contract. And then when that 15-minute up or the hour up or the 4 hour up, it cuts off. Rise or fall. Whatever direction that it actually close in, it could be a break even, it could be a rise above or rise below. It's a fixed payout you will get. So it doesn't matter how far it goes above where you go long or click rise, or it doesn't matter how far it goes down where you click short, you get a fixed payout once you put up that stake. In Forex now, if it keeps rising, you keep making. It keeps dropping, you keep making. Nice. And the futures approach, you got to go a whole 1,000 points or 1,000 move, incremental move again, before you even get another 20% return. So when you look at the different platforms and the different ways, you will realize why people use this and fail. Not because of so many different dynamics around. This looks really good on paper. It looks fantastic on paper. Trust me. And it looks like it's really achievable with the scalping and the day trading, and you could get in the market and all you need is that move and that move. But every one of them is associated with risk. And you already don't know the right education. You don't have a proper trading system. Nice. And you're going to go in financial markets. You can look for how much liquidity, sweep, trigger, value, turtle soup, crab soup, supply and demand, support and resistance, breakout, break and retest. You could go on the 1 minute, 5 minute and try to. This is going to destroy you. That's not how we do it. That's not how we do it. How does professional traders do it? This is how we do it. This is how professional traders do it. We got $1,000 account. We are looking at a 10% exposure. So when we take 10% out of our $1,000, that's $100 here. So this is money management. Money management is where we take 10% out of our $1,000. So now we have 100 to expose. We have our directional bias. We got 5 longs, nice, on some pairs. We got 5 shorts on some pairs. Those are everything that are going to rise. Those are everything that are going to drop. Okay, cool. Now we got to allocate this money over those pairs and them. So we got 1 position, 2 position, 3 position, 4 position, 5. 1, 2, 3, 4, 5. Great. How much pips are we risking per? Now we want a $10 exposure. So let's say we're going to use the whole $100. Nice. We got a $10 here, $10 here, $10 here, $10 here, $10 here. We got 10 here, 10 here, 10 here, 10 here, 10 here. Right. So we got 50 on the longs, we got 50 on the shorts, and that's how our portfolio will look like. And we're going for 1,000 pip increment move. Nice. So we're going for 1,000 pip increment move. Right. So that's the quarterly level there. Alright, so we're risking 100 to go for 1,000 pip increment move. We're risking 100 to go for 1,000 pip increment move. Great. So that's what our returns will look like. But look at how our exposure is very small. Nice. Our exposure is small. That is what limits down everything here. That limits down the entire thing. So this is how we will do it. And then we have an approach of how we read the market. Long, short, correlation, diversification. So we could catch the market swings on them when the market is moving a level like that, moving a level like that, and then moving a level like that. Nice. It's moving a level down, moving a level down, moving a level down. And then we run that between a 1 to 3 or 20 to 60 days, and nothing here can blow us up. And even if all the trades don't play out, we still make money, and we only need a little more than a 50% win rate. We only need a little more than a 50% win rate, and we're making money. If we have 60, we are doing pretty well. If we got 70, extremely well. So all the trades, now win all my trades, and you don't have to win all the trades. And you can still make money all the time, and you don't need no 95% win rate, or no 100% win rate, or no 90% win rate. 50, 60, that's what the professionals and them have. Or you can be better than the professionals. You as a retail trader, you even know what's going on the other side of the fence. The professionals and them have this, and this is their framework, and this is how they're applying their risk, and this is how they're running their portfolios, and this is what happens every time in their portfolio. Some of the trades go against and stuff, and they have a spread structure. So if the shorts come up and the longs go up too, but the short doesn't come up as far as the longs, still making money. Short goes down, long come down, but not as far as the shorts, still making money. They call that spread trading. But the ideal thing is the way we read the market with the dealer cycle and the template and the levels, and we do our qualitative work, quantitative work is stocks and forex. Same approach with the levels and cycles. Nice. We want our longs to go up and our shorts to come down, and that makes our portfolio good. But let's say some of the trades just don't move at all. Go into something called fractional disparity and it doesn't move. No problem. The rest of them, there are other trades in there So the more trades we take, it gives us more opportunities to be right. It gives us more chances to be right. If something don't move, the rest of them moving. If something turn around, we have others that are actually going. And once we keep billing and dumping trades in our portfolio like that, we just keep making money all the time. So we losing trades all the time. Some of them are moving, some of them turning around. But every time we build our portfolio like that, the money just keeps coming. We always ending in net profit, even though it have trades inside of that bunch of trades that are not playing out. That is how professionals do it. Hope you all learned something there. Get some value from it. Learn.